Hello everyone, welcome to our Non-Farm Payrolls live event here at Markets.com. You join me in my home. We're working from home still on the Fridays, and we are looking at Non-Farm Payrolls coming up in about 10 minutes. That is going to be another print, we think, of around 200,000 new jobs. That's going to be the lowest in a long while, but whilst there are signs that labour growth or jobs growth has moderated somewhat, it's still pretty strong. It's still clearly strong enough for the Federal Reserve to keep on hiking. As we heard from Jay Powell on Wednesday evening, he struck a very hawkish tone on the path of interest rates and said now was not the time to think about pausing. And he said that the terminal rate, the maximum level of the Fed funds rate that they are going to get to, that will be higher than previously thought. So a lot riding on the jobs report again today. We're seeing 200,000 as the consensus estimate. There are various estimates, but around that 200,000 mark would be around the consensus. Wages are seen up 0.3%, though slight moderation from 5% growth annually last month down to about 4.7% annual growth in wages, and that will be something that the Fed is looking for very, very carefully, because that's where there's problems. If the labour market continues to be strong and wages continue to grow, then it's not going to be able to get a grip on inflation really until it hikes even more aggressively. Unemployment is seen just ticking up slightly to 3.6% from 3.5% previously. That was after that unexpectedly large decline in the month of September. Participation rate seen at 62.3%. Yada yada, a few things, average hourly earnings and so on. As I say, 5% growth there. ADP numbers this week were unexpectedly strong. They came in at 239,000 versus 195,000 that had been anticipated. So ADP strong. Now those ADP numbers can be a bit of a misreading ahead of the non-farms, but nonetheless strong. ISM manufacturing employment this month, or well last month, up to 50 from 48.7 prior. Services though was weaker, down to 49.1 from 53 prior. Challenger jobs cuts up to 33, almost 34,000. From 30,000 prior. Empire Fed employment 7.7 versus 9.7, so real mixed picture, some strong, some weak. Initial jobless claims this week 214,000. That's not really important for the non-farms today. I think really it's the September JOLT openings that are the most important here, and they rose to 10.7 million, up from the 10 million that had been expected. So all in all, the labour market seems in pretty decent shape overall, but jobs growth not growing at the pace that it has done over recent months. Coming into today's meeting, we've got the futures just trading a bit higher. It's the Tech 100 behind me on the screen. That is trading at around 10,758 at the moment. That's the Nasdaq 100. That's been offered pretty sharply this week after the hawkish commentary from the Fed. Also the earnings releases last week from the likes of Meta, Microsoft, Alphabet, and so on. But really, it's the hawkish Fed that's doing a lot of the damage here, because of course the higher interest rates go, the less appealing, riskier assets become. So future trading a bit higher. The dollar's firmer as well. We've got cable trading around that 112 level. It had been up at 116 before this week. That's come off with the hawkish Fed, but also the Bank of England raising rates in a pretty dovish fashion yesterday. They were, although they raised rates by 75 basis points, it was a pretty dovish message saying that they don't think that the terminal rate, again that's the rate, the highest peak in the interest rate that they set, that terminal rate in this cycle will be less than what the market is anticipating, and so that is what did for cable really yesterday, and that's why sterling continues to trade weaker against peers today. But better news on the stock market front in Europe, and the FTSE trading nicely higher today after, really on these rumours around China reopening shortly. So there's all sorts of chatter in social media about how China could look to reopen its borders and its economy, more importantly, much sooner than maybe we thought. That it's going to move away from zero COVID. All this rumour mill chatter has driven some big gains for Asian markets, for the Hong Kong index and for some of the mainland indices too. But also because of that, you're seeing a real put into basic resources stocks, so energy, miners and so on, then they're getting a real lift today. I saw Anglo American up very strongly earlier. It was up 7% at the open. So some real big moves in some of the basic resources numbers, and so that's helping the FTSE today. But we are still waiting on this print from the Bureau of Labour Statistics. Just a recap, it's 200,000 that we're expecting on that number. I think really you do have to also weigh in the fact of Hurricane Ian and what kind of impact that might have had on the labour market as well. But really, probably the most important thing that we'll be looking at is the wage growth number. If that does surprise to the upside, then you start to look at next week's CPI number from the US as being ever more important, the next data event and risk event for the market. And that of course, is the one in the rear view mirror for that CPI print was up 0.6% month on month for the core reading. Core inflation starting to really accelerate, even as energy maybe comes off a bit. And so core prices accelerating, the Fed is in absolutely no position to stop hiking rates, and that's what we heard from Jay Powell. So just on this number today, if we get a strong wages, strong print, then it really just underscores the Fed's hawkishness. Fed hawkishness tends to mean weaker outlook for riskier assets. So stocks lower, US bond yields move higher, and the US dollar might advance. And if we just check on the dollar, we just got it trading at 112.5 just about at the moment. So just trading a little bit off the highs from earlier, but still pretty solid at 112, and we'll wait to see whether or not there's any major reaction to the jobs number from that in that index. S&P just trading at 37.40 there. So broken down, it's breached that sort of 38-39 level. We've been trading between those two levels for a while, and actually I think it was trading on Wednesday pretty much between its 150-day moving averages. So that was around 38 and 39. Those 150-day moving averages, it's broken down below that level. They're not quite sure whether or not that means it's going to be a flush or whether there's another leg lower. Some people are talking about the midterms next week being a catalyst for a leg higher for the market. Midterms usually, once they get out of the way, you move higher in the S&P. Question mark really is over the Fed. Is there any more uncertainty about the Fed, or do we know roughly where it's going? I think what you heard from Jay Powell on Wednesday was that the Fed doesn't know exactly how high it needs to go, and I think this is the risk for the market, is whether it's the Bank of England saying they think the terminal rate is being priced too high at the moment, or it's the Fed saying we think the terminal rate might need to be a bit higher. The point is they don't know how far they need to go, and they're not confident in the terminal rate. The Bank of England's trying to sound confident, it's not at all. It's worried about the economy. It's trying to keep interest rates as low as it possibly can, while still battling inflation, because it's got the Chancellor calling for low interest rates. It's got the mortgage market under pressure. It's got an economy which, if we do get to 5% on the bank rate, would decline by 5%. So it's a really tough position for the Bank of England. But the point is, I think the takeaway from this week is that no one knows where the terminal rate is. No one knows just how high central banks are going to have to go. And so that means there's still too much uncertainty to get really bullish on risk assets. I think whilst we will see legs higher and these sort of bear market rallies continue to come, then we are still in a risky place. I'm just going to put the S&P up, and then we've got our news feed. So just wait for the numbers to cross in the next couple of minutes. I think we should just be getting a number out in the next few seconds. So 200,000 is what we're looking for. Higher than that, you maybe see the market come off a bit. Lower than that, maybe get a movement to the upside. Just coming in now. You're just seeing the S&P just moving a little bit on that, so still trading at 37.39. I think we're just waiting on it. Just coming. It won't be more than a few more seconds. There we go. Oh, shoots higher. So leg higher for the S&P there. So initial break massively high. and then massively lower. So huge swing. So 260,000, 261,000, but moving sharply lower. I'm going to bet that that's on some hot wage numbers. Unemployment rate ticks up to 3.7, so that's a tick up in unemployment, is a little bit higher than had been anticipated. But the direction of travel is right, that the unemployment rate is actually moving a little bit firmer. And we're just waiting on the wage number to cross, because that is a huge movement in the S&P. It's moved by about 60 points in either direction off the back of that, and it's not quite sure. It's still making up its mind now. So the futures are moving lower. You've got the Dow just moving 0.2% below the flat line, now higher. So movement in all directions. Is a really strong movement on this payrolls report. Coming in 261,000. That is well above the 200,000 or so that had been expected, and we've got 3.7% on the unemployment rate, and we're just going to see if we can get the wages number up. Let's try and get our wages number up. Not flashing on the wires. Average hourly wages, yeah, so they were a little bit hot, 0.4%. So on month wages were up 0.4%. That was more than the 0.3% that had been anticipated. That's seen actual hourly earnings year on year, though, were still up 4.7, which is in line, but it's the month on month level, the 0.4% month on month, that is important, and that's really maybe why the market just moved to the downside. But a lot to digest here, I think, and it's not quite clear whether this pushes the market higher or lower at the moment. I think really hot jobs number coupled with strong wages suggests it's bad for risk, because it means more hikes. But that rise in the unemployment rate is just something that will be in the minds of the Fed officials right now, because they'll be wondering whether the lag effect of their monetary policy and their hiking is going to start to weigh on the labour market in the coming months. They don't want a hard landing. They're trying to engineer a soft landing, and that means they might need to slow down and eventually stop their rate hikes. But for now, it doesn't look like the numbers add up on that front. So anyway, market seems to be a bit lower, dollar a bit firmer, but some of these initial moves, knee-jerk moves, are being retraced as we speak. So that's it for now. Thanks very much for joining.